So at a time when several South African retailers are quietly retreating from foreign markets, Mr. Price has decided to charge into the fray. So just yesterday, the group announced a nearly 10 billion rand deal for NKD, this value chain with more than 2,000 stores across Europe. And then it watched its stock price for more than 10% in a matter of hours. Now, before we get into why investors hated it, it's worth noting how sharply this breaks from the national script. I mean, we just mentioned earlier this week, SPAR is dismantling its European footprint, Woolworths is still absorbing fresh losses in Australia, and Shoprite continues to unwind operations across Africa. And so the momentum here in South African retail seems to have shifted inwards, simplifying the balance sheet, pulling capital home, and avoiding these foreign surprises. Now, with that backdrop in mind, why exactly aren't investors happy? Well, let's start with the fact that Mr. Price is paying 37 times NKD's annual earnings. It's loading 5 to 6 billion rand in debt onto a historically clean balance sheet, and it's stepping into a low-growth, geopolitically uncertain region. Investors fear that the retailer is paying a premium for thin margins and repeating a pattern that many South African retailers haven't been able to break. Now, Mr. Price, though, argues the opposite. They say that Europe's value segment is growing, NKD's model mirrors Mr. Price, and these past acquisitions that were once doubted went on to become high performers. And so whether this becomes their next success story or just another offshore cautionary tale, now comes down to execution. And to catch our full daily news show, check out our accounts or give us a follow for more news updates.